You've been watching mortgage rates for 2 years, and they won't drop. Your mortgage payment feels impossible compared to last decade. Nobody explains why rates are stuck, or what actually moves them. Here's what's really happening inside the housing finance system. Most people think a bank just decides mortgage rates. That's not how it works at all. Your mortgage gets sold within days of closing. Then it gets bundled with thousands of other mortgages into something called mortgage-backed securities. Those securities get sold to investors around the world. The price investors pay for those securities determines your rate. This is the part nobody notices. If fewer investors want to buy mortgage securities, prices drop and rates climb. If more investors want them, prices rise and rates fall. But here's the twist: for the past 2 years, rates have been trapped in a narrow band. They hit nearly 8% about 2 years ago after spiking from pandemic lows. Since then, they drifted down a little. But they've been stuck between 6% and 7% for an unusually long time. Why won't they move? Because nobody is buying the securities that would push demand up enough to shift the price. Investors are waiting. They're unsure about inflation, Federal Reserve moves, and economic direction. So they hold back, and your rate stays frozen. Meanwhile, you're doing the math. A $400,000 home at 7% costs you roughly $2,660 per month for 30 years. That same home at 5% would cost $2,147 per month. That's $513 per month. You don't have over 30 years. That's nearly $185,000 more you'll pay. And that's before property taxes and insurance. Most people don't realize the rate is the whole story. A small percentage shift changes how much of your adult life goes to a bank instead of your family. Here's the system behind it. When a loan officer approves your mortgage, the bank doesn't hold it. They immediately sell it to what's called a government-sponsored enterprise, or GSE. The two main GSEs are Fannie Mae and Freddie Mac. These aren't banks, and they don't lend directly to home buyers. They sit in the middle of the entire housing finance system. The GSE buys your mortgage from the bank. It bundles your loan with thousands of others. These bundles become mortgage-backed securities. Then those securities are sold to pension funds, insurance companies, foreign governments, and investment firms. These are conservative investors looking for stable, long-term income. This system works only if there's demand for those securities. Demand determines price. Price determines the interest rate you get offered tomorrow. In 2008, the system broke because nobody wanted the securities anymore. People defaulted on mortgages they never should have had. The securities became radioactive. Investors fled. Fannie Mae and Freddie Mac couldn't absorb the losses. The government stepped in and took them over. Both companies were placed into federal conservatorship in September 2008. This means the U.S. Treasury now owns them. In effect, taxpayers are on the hook if things go wrong. This fact matters more than most people realize. After the bailout, the Federal Reserve tried to push rates down using quantitative easing. They bought trillions in Treasury bonds and mortgage securities. That artificially pumped up demand and kept rates low. It worked for a while, but then inflation came back. The Fed had to stop buying and start raising rates without that artificial demand prop. Mortgage securities became less attractive. Investors demanded higher yields because everything was riskier. Rates climbed back up. Now here's where the system gets real. The Federal Reserve isn't interested in helping mortgage rates right now. They care about controlling inflation. Lower rates would make inflation worse, so they're staying out of it. This creates a vacuum. Mortgage rates should fall because the economy is slowing. But the Fed isn't buying securities anymore. Without a buyer, there's no demand spike. Without demand, there's no price increase for securities. Without that, rates stay stuck. This is where policy comes in. If policymakers want rates lower, they need to create demand for those securities somehow. One way to do that is to order the GSEs themselves to buy more mortgage-backed securities. That's exactly what happened. A policy directive ordered Fannie Mae and Freddie Mac to purchase $200 billion in mortgage-backed securities. After the bailout, the Federal Reserve tried to push rates down using quantitative easing. They bought trillions in Treasury bonds and mortgage securities. That artificially pumped up demand and kept rates low. It worked for a while. The logic is straightforward. If Fannie and Freddie are buying, demand increases. Demand increase means prices rise for the securities. When securities cost more, yields fall. When yields fall, the rates offered to new borrowers fall too. That's the mechanism. But here's the part that changes everything. Fannie Mae and Freddie Mac don't have infinite capital. They're leveraged entities that rely on Treasury support. The Treasury backs them because they're considered critical to the housing market. If these securities purchases go badly, if home prices fall and people default, losses get socialized. That means taxpayers absorb the downside, banks keep the upside. When mortgages perform, taxpayers cover the losses when they don't. This is structural risk most people never think about. Let's ground this in real numbers. If the $200 billion purchase successfully pushes rates down by 50 basis points, that matters. 50 basis points takes $400,000 average loan equals roughly $150 per month savings. That's $1,800 per year for one homeowner. For 1 million home buyers, it's $18 billion in annual savings. Results vary based on loan size, timing, and actual rate movement. But if home prices fall 10% while the GSEs hold these securities, losses could be substantial. 10% decline to $200 billion equals $20 billion potential loss. That loss doesn't disappear. It gets transferred, and taxpayers, not the investors who profited during the boom, cover it. This is why housing policy is always controversial. There's no neutral version of it. You either help borrowers by accepting taxpayer risk, or you don't buy, rates stay high, and affordability stays broken. Most people feel this as a personal crisis. You want to buy a home, but rates are punitive. You want to refinance, but the math won't work. You're watching prices stay inflated while rates stay elevated. The combination is suffocating, but the system doesn't move on hope or individual pain. It moves on capital flows and investor demand. Without understanding that, it feels random. Once you understand it, you see it's actually mechanical. That's not reassuring, but it's clarifying. The longer rates stay high, the more pressure builds for government intervention. Historically, that intervention comes through the Fed. But when the Fed can't help because inflation is the priority, intervention shifts to direct purchase programs through GSEs. This is unconventional, which means its effects are unpredictable. Some economists argue that it will work, demand will increase, prices will rise, yields will fall, rates will follow. Other economists worry about inflation, market distortion, and hidden losses down the road. Both arguments have merit. Results vary based on economic conditions. Neither group can fully predict. What matters for you is understanding that mortgage rates aren't set by the bank. They're set by the demand for mortgage securities in global markets. That demand is influenced by Federal Reserve policy, investor sentiment, inflation expectations, and now direct government purchases through GSEs. When rates finally do fall, it will be because demand for those securities increased. You'll see it in the rate quoted to you. But the reason will be buried in policy and markets most people never pay attention to. This is the hidden rule. Your monthly payment isn't determined by your credit score or your bank. It's determined by what institutional investors are willing to pay for the bundle of mortgages your loan gets packaged into. That's a system, not a personal transaction. Understanding it won't make rates go down faster, but it will stop you from blaming yourself or feeling random about it. You'll know that the system is responding to capital flows, not to your need. And you'll understand why policy changes in Washington actually do show up in the mortgage quotes you see next week. Most people miss this connection entirely. They think housing is local. They don't realize it's tied to global bond markets, Fed policy, government GSE directives, and investor sentiment. When you see it that way, a lot of financial stress starts to make sense. You're not stuck because you're bad with money. You're stuck because the mechanism that prices mortgages is stuck. That's a system problem, not a you problem. Here's what that means practically. If rates do fall from policy intervention, the window could be narrow. Policy-driven rate drops often fade quickly as the market digests the impact. If you're considering a purchase or refinance, the timing becomes important, not because rates will never be lower again, but because policy moves create temporary openings. Similarly, if you're building wealth in real estate, understanding the mortgage system matters. Property appreciation is great, but your actual wealth depends on the interest rate you're paying. That rate is determined by forces way bigger than your local market. A national policy change filters down to your local rate within days. The second thing this reveals is taxpayer exposure. When government agencies are buying securities to manage mortgage rates, taxpayers are accepting risk. That's not inherently bad, but it's real. In crisis scenarios, that risk materializes. Most people never connect their tax burden to housing policy, but they should. The third thing is that the housing finance system is fragile. It works only when investors trust that mortgages will perform. That trust evaporates quickly. When it does, the entire mechanism that prices your mortgage collapses. We saw it in 2008. We're seeing echoes of it now, even though it hasn't broken for you. The takeaway is simple: mortgage rates move when capital demand moves. Your bank doesn't control it. Your credit doesn't determine it. The system does. Understanding that system is the foundation for every housing decision you make. When someone tells you rates will drop, ask them what's the mechanism? Is it Fed policy, GDP growth, inflation falling, investor sentiment shifting, or government purchase programs? Different mechanisms create different timing and different certainty. Most people never ask this question, they just hope rates fall. Hoping doesn't move capital. The honest answer is that mortgage rates will stay elevated until one of several things happens. Inflation needs to fall enough that the Fed can ease economic growth, needs to be strong enough that investors buy securities even at higher yields. Or the government needs to buy enough securities directly that it shifts the demand equation. One of those three has to happen. Right now, only the third one is being attempted. Whether it works depends on how much the GSEs buy, how long they buy, and whether investor sentiment shifts in response. It also depends on home prices and defaults. If those trend badly, the securities the government bought become underwater. Results vary based on economic path nobody can predict with certainty. This is where you find relief. You stop blaming yourself for the impossible housing market. You stop waiting for rate drops that may not come. You start understanding that housing affordability is a policy problem, not a personal failure. That mental shift changes how you plan. Instead of hoping rates fall, you plan assuming they stay elevated. Instead of betting on a refinance bounce, you budget for the rate you have now. Instead of feeling trapped, you feel informed. That's the system. Click the moment you understand how mortgage rates actually work, the anxiety shifts from personal stress to structural clarity. You can control the system, but you can stop blaming yourself for being stuck inside it. And you can make smarter decisions knowing the system will only shift when capital demand shifts. 3 quiet truths about mortgage rates. Rates move based on investor demand for securities, not on your creditworthiness. Government intervention in the mortgage market transfers risk to taxpayers. Housing affordability is a systemic problem that requires systemic solutions, not personal effort alone. If mortgage rates matter to your next move, confirm the current mechanism with a qualified mortgage professional for your situation. Everything here helps you understand the forces at work, but your specific lending decision should account for your own circumstances and timeline.